The head of markets research at Asia Pacific at Rabobank joins us on the phone line to talk about that. Michael, hi, good morning, and thanks for taking the time out for us. The ECB, in a sense, has disappointed global markets, and we're seeing it, in the US markets and even in Asia this morning. But how would you read into the event?
Well, I think it really just symbolizes or exemplifies the fact that we live in really farcical financial markets at the moment, which was best summed up actually by the Financial Times printing the wrong ECB announcement a few minutes before the announcement and having to retract. But really, at the moment, no good deed goes unpunished. The ECB have attempted to try and be more moderate than perhaps they could have been, not actually increase QE, just extend QE, still making a further rate cut into la-la land, negative territory, but overall, relatively, being quite moderate. What happens? The euro gets pushed up 4 big figures. The stock market drops 3.6%, and bond yields jump 20 basis points. Yep. And, the problem is really that in these ridiculous financial markets we find ourselves living in, if you're rational, the market completely reacts irrationally. So, basically the market is forcing you to continually up the ante and be ever more ridiculous.
Yes, I agree with those contradictions, Michael. But, well, for emerging market investors who are now trading at this hour, is the ECB event not so terribly important? Would they have their eyes cocked more on what Yellen said and is therefore likely to do on December 15 and 16?
Well, I think they're both important because effectively Yellen, we know, is going to be the Grinch who stole Christmas, and by, raising rates, that's absolutely going to be happening. But at the same time, the ECB, everyone had been relying on them to be Santa Claus and to be, ever more ridiculous by throwing ever more liquidity into the market. And that's why they're disappointed. The BOJ haven't done it, the ECB haven't done it, and the Fed are going to be doing the opposite. So if you put those three together, at the moment, temporarily, everyone's behaving like an adult. And markets don't like it when that happens.
Okay, so in a sense now it will be the end of that easy money or free money period. Given that situation, Michael, do you expect money to be pulled out of emerging markets in the next, say, 3 to 4 months, if it hasn't been already?
Well, I think that's too long a timeline to talk about because, to be quite honest, first of all, we're still in an incredibly easy money environment. We're only talking about not making it even easier, which really underlines just how crazy the situation is. It's not that we're actually reducing how easy it is, except maybe in the US. We're just not making it easier. And for emerging markets, well, 3 months, 4 months is a long time. If we continue to see the euro push higher, if it continues to push up 110, 111, 112, let's just presume that happens. I wonder how long it will be before the ECB has to turn around and say, all right, the market has forced us to be even more ridiculous and we will extend QE. So, 4 months, an awful lot can happen in that particular time.
Okay, we'll leave it at that. Michael Lavery, thank you very much for joining us and giving us your views on the ECB action. We have another expert joining us, George Hoguet, the global investment strategist at State Street Global Advisors, on the line from New York. George, good evening. Thank you very much for staying up for us. How do the events of the announcements from the ECB and Janet Yellen's testimony yesterday square things for the way money will move? Do you think that we are going to see more money being abandoned from emerging markets? Do you think the dollar will get stronger?
The events of the past 2 days have not fundamentally changed our view of the world. We do think that the dollar will continue to strengthen, that many emerging market currencies will continue to weaken, and in fact the euro will continue to weaken over time, given the differences in the economic fundamentals between the United States and the Eurozone. So while there was disappointment, clearly, and the markets were surprised in the ECB's decisions, we don't believe that this fundamentally changes the underlying dynamics at work in the world economy.
Okay. George, good morning. For the last 6 months, the emerging markets have underperformed the developed markets because of a variety of reasons. Do you expect that trend to continue?
Yes. The reason for that is that we believe that the Fed funds rate will be at probably 1.25% By the end of next year, that means the 10-year will be close to 280 or so. And the differences in real yields between the developed world and the United States and emerging markets are narrowing. But more importantly, I would say, is that a number of emerging economies have not engaged in fundamental structural reforms. So we see this in Russia. We see this in Brazil, which is undergoing a very difficult period now. And I think there's more confidence in the policies in the developed markets than there is in the emerging markets. You add to that the slowdown in global trade, which has grown much less rapidly post-global financial crisis than pre-crisis, and sentiment is still negative on emerging markets.
Yeah. George, we saw the euro become expensive from 1.06, even 1.55 before the ECB announcement to 1.09 at this point in time. Do you think that it gets even more expensive, or do you think after mid-December, when the Fed action is known, we could end the year closer to 1.06 on the euro?
Yes, I do. And if you look at Europe and think about the multiple challenges that it faces, I think there are good reasons to believe that might be the case. Let me just go through some of the things that Europe is facing. You have Greece now continuing to struggle and in non-compliance with its most recent bailout. Of course, you have the refugee crisis. You have a continuing security problem in Ukraine. You have the possibility of Brexit. You have high debt levels and weak growth continuing in the periphery. You have the possibility of Catalonian secession.
Yep.
You have the Volkswagen crisis. There are a lot of reasons to believe that the euro will weaken.
No, my point was, would you expect dollar to go again, that dollar index, that is, to go again over 100 and again start impacting commodities?
Well, I think the dollar is likely to continue to strengthen over the next 6 months. I think that'll be an erratic path, but that's our core forecast, that the euro will continue to weaken.
Okay, and one final question on the Indian markets. I heard you mention that emerging markets like Brazil are under quite a bit of pressure, but India has also seen its fair share of FII money getting pulled out this year. Do you expect that to continue?
Yes, although at a less rapid pace than other emerging markets. The reason is, when people invest in emerging markets, they think of the asset class as a whole rather than just thinking about investing in one country. Now, that'll change over time as the Indian and Chinese economies become larger, but India will be caught up in larger events.
All right, we leave it at that. George Hoguet, thank you very much for staying up for us and giving us your views on how the dollar and the euro are likely to move. So, well, dollar strength eventually, so perhaps 100 probably even before the year is out.